Have you ever wondered how some people seem to make their money work for them, effortlessly multiplying their wealth in the stock market? How they turn the complex world of stocks, bonds, and dividends into a playground where they seem to always hit the jackpot? Do you ever find yourself wishing for that magic key that unlocks the secrets of the stock market? Well, you're not alone. And today, we're going to demystify the stock market for you. Before diving into the action plan, let's understand some basic concepts. The world of investing can seem like a jungle to the uninitiated. But fear not, we'll equip you with the compass and map you need to navigate it. Let's start with the basics. What is a stock? Simply put, a stock represents a share in the ownership of a company. When you buy a stock, you're buying a small piece of that company. You become a shareholder, which means you have a claim on part of the company's assets and earnings. Now, where do you buy these stocks? That's where the stock market comes in. Picture it as a giant global marketplace where buyers and sellers meet to trade stocks. Each day, billions of dollars change hands in the stock market, making it a vibrant and dynamic part of the global economy. But why do people invest in stocks? The answer is simple. Investing in stocks offers the potential for substantial financial growth. Over the long term, stocks have consistently provided a higher return on investment compared to other forms of saving. It's a way for individuals to build wealth over time. However, it's important to remember that investing in stocks also involves risks. The value of a stock can go up and down, sometimes dramatically, due to factors like the company's performance, general economic conditions, and market sentiment. That's why it's crucial to understand these concepts before you start investing. Investing is not about getting rich quick. It's about making informed decisions, taking calculated risks, and being patient. It's about understanding the difference between price and value, between short-term fluctuations and long-term trends. It's about being part of a company's journey and sharing in its success. So, arm yourself with knowledge. Do your homework. Understand what you're investing in and why. And remember, every great investor started somewhere. Now that we've got the basics down, it's time to talk about how you can start investing. Step 1 of our action plan involves setting clear financial goals. Now, why is this so crucial? Well, without a compass, it's easy to lose your way. The same principle applies to finance. Your goals are your compass, guiding you through the labyrinth of investing. Let's think about these goals for a moment. They could range from saving for retirement, funding your child's education, to buying a house, or even just growing your wealth. Each goal will require a different investment strategy. For example, if you're saving for a long-term goal like retirement, you might lean towards more stable long-term investments. On the other hand, if your goal is to buy a house in the next 5 years, you might opt for less risky short-term investments. Remember, your financial goals should be SMART: specific, measurable, achievable, relevant, and time-bound. With clear goals in mind, you can move on to the next step. Step 2 involves doing your homework and choosing the right stocks to invest in. Now, this isn't as daunting as it sounds. It's a little like shopping for the perfect pair of shoes. You want something that fits, is comfortable, and will last a long time. First, you need to research. This involves looking at a company's financials, understanding its business model, and getting a sense of its future prospects. You can start by checking out a company's annual report and quarterly earnings releases. These documents will give you a snapshot of the company's financial health, its profits, and its growth trajectory. Next, you want to understand the company's business model. Is it a tech giant with a firm grip on the market? Or is it a small biotech firm with a promising new drug? Understanding the nuts and bolts of a company's operations will give you a sense of its potential for future success. Now, on to the future prospects. This is where you'll need to put on your fortune teller's hat. You want to look at the company's growth strategy, its plans for expansion, and any potential risks on the horizon. You also need to consider broader market trends. Is the industry the company operates in growing? And how does the company stack up against its competitors? Finally, you need to choose stocks that align with your financial goals. If you're looking for steady income, you might lean towards established companies that pay regular dividends. If you're aiming for growth, you might consider younger, high-growth companies. Remember, investing is not about chasing the latest hot stock. It's about making informed decisions based on thorough research. It's about finding those perfect shoes that will carry you comfortably towards your financial goals. Having chosen the right stocks, you're ready for the next step. Step 3 is all about diversification. It's the investor's equivalent of not putting all your eggs in one basket. The concept behind diversification is simple yet powerful. By spreading your investments across a variety of stocks and sectors, you can mitigate risk and increase potential returns. But how do you effectively diversify your portfolio? Well, start by investing in companies from different industries. This way, if one sector takes a hit, others might still be performing well to balance out your losses. You can also consider investing in both small-cap and large-cap stocks. Small-cap stocks may offer higher growth potential, while large-cap stocks are typically more stable. Another aspect of diversification is geographical spread. Investing in companies from various regions can protect you from the instability of a single market. Remember, diversification doesn't guarantee profits, but it can definitely help reduce potential losses. With a diversified portfolio, you're well on your way to becoming a successful investor. We've covered a lot today, so let's quickly recap. In the whirlwind of investing, it's all too easy to lose sight of the basics, so let's take a moment to gather our thoughts. We started our journey with understanding the fundamentals of investing, reminding ourselves that the stock market is not a casino, but a platform to invest in businesses. We then moved to the first step of the action plan, setting clear financial goals. Remember that investing is not a one-size-fits-all activity. Everyone has unique financial circumstances and aspirations. Hence, it's crucial to outline your financial goals before you start investing. Next, we delved into the second step, researching and choosing stocks. We emphasize the importance of doing your homework before investing in any company. Look at the company's financial health, its competitive position, and the industry it operates in. Choosing the right stocks is a critical step in the investing journey. And finally, we discussed the third step, diversifying your portfolio. Spreading your investments across different sectors and companies can help mitigate risks. Remember, don't put all your eggs in one basket. Diversification is key to weathering the inevitable storms of the stock market. Remember, investing is a journey. It takes time, patience, and a well-thought-out plan. Happy investing!